So, welcome everybody, and thank you for joining us. My name is Dr. Patrick O'Malley, the founder of ShiftChange, and your moderator for today. Just a quick word about ShiftChange for those who are new here. This is where clinician entrepreneurs come to build income and wealth that does not ride on you just working your next shift. We bring together clinicians who are investing, launching businesses, and creating real options for themselves. And we run live sessions like this with people who have already walked the path. We share playbooks, connections, and give people straight answers. And if that's what you're after, you're in the right place. And today's topic is one of the biggest levers that clinicians have for building wealth outside of the clinic, which is commercial real estate. Now, most of us know real estate through our own home, maybe a rental property, but commercial assets are a different game. Office, retail, industrial, and multifamily. And that's where scale lives. And it's often the piece that shifts your income away from hours worked towards assets that actually work for you. But it can feel like a very closed world until someone shows you how it runs. And that's what today is about. And our speaker is the exact person to open that door. Dr. Manang Desai is a board certified emergency physician and clinical executive with over 20 years of experience. He's a physician, an MBA, and he has a track record of scaling healthcare organizations from millions into the billions. He knows the clinical world that we all come from and the business world where wealth gets built. So he's going to go through some of the fundamentals, property types, strategies that balance return against risk, and the basics of buying, leasing, and managing these assets. And whether real estate is an investment, a career path, or a business for you, you'll leave seeing how this market actually works. So Dr. Desai, welcome, and we'll turn it over to you.
Well, good afternoon, everyone. Patrick, truly appreciate the opportunity to talk about my passion, commercial real estate. Of course, used to wear a lot of hats, including, of course, healthcare. But I'll kind of march through some of these slides. I'm happy to take questions, kind of keep it a discussion format. But the reason I put this formula on the front or the first slide is because at the end of the day, especially all of us who are clinicians, we're STEM people, right? And I don't think of commercial real estate much differently than the math and the science that we've known for decades. Commercial real estate is literally a lot of inputs and a lot of outputs. And it doesn't happen overnight, but you have to understand what those inputs and outputs are and the factors and the variables that will impact the yield at the end of the day. And so while this is not a full, expansive, commercial real estate discussion, hopefully it kind of whets the appetite for some. And if you walk away with a lot of questions, that you're pondering, I think that's actually a good thing, not the other way around. And that's probably with all types of investments. You should ask a lot of questions and take a lot of time to study because it's at the end of the day, it's your money and it's your time that's going into these investments. But just a little bit about myself. I'm an emergency medicine physician. Grew up in the southern United States, med school in Alabama, and then came to Houston to finish emergency medicine training in the late 90s. And about 3 or 4 years into clinical practice, took on a lot of roles early in my career, including being a medical director, a regional director for national contractors. 8 of us physicians had a kind of a wild brain idea to open a hospital. I don't think many people do it at the scale that we do. I drained my real estate or my retirement accounts, and with 7 other physicians, bought 30 acres on a highway. Fast forward almost 15 or 16 years, we built a 170-bed hospital, lots of multi-100,000 square foot POBs. And one of my roles was expanding the real estate footprint off the main campus, building emergency rooms, along with imaging and small professional office space out in communities. It's kind of your classic wheel and spoke idea of pushing patients back to the main campus. And then in 2018, after an incredible 15-year run, we sold the hospital to a strategic HCA, which is, of course, a national organization. I stayed on for 2 more years. And at about the tail end of COVID, I left North Cyprus. Used to run the emergency room group and a lot of other roles, including revenue cycle. And so my hand was in a lot of things in business, but one of those things was really centered around real estate development and finance, whether it be operational companies or the real estate. And that's really when Malabar Hill Capital was born. And I'll kind of get into Malabar Hill, but probably over the next 2 or 3 slides to really talk about real estate and how the investment thesis for Malabar Hill started. A lot of my fellow physicians at North Cyprus wanted to do more in real estate. They continued to practice, but they wanted to do it passively. And they knew me as a heavy operator in the hospital space. And so 25 of them entrusted me with their capital, and we started building retail shopping centers. And so the shopping centers that we build are typically at the entrance or within the middle of a big, large master plan community. If you're throughout the United States, master plan communities are abundant in Texas. They're typically 3, 4, 5,000 home communities. They kind of have a life of their own. There's schools within them. Some of them are as large as 3, 4, 5 miles wide. And so they have commercial space within commercial tracts or land within them. And that's what we develop into shopping centers that people can go and visit their dentist, primary care doctor, pizza concepts, lots of food concepts, personal care, their gyms, Orange Theory, etc. But we're not operators of those businesses. We build the shopping centers, fill them up with incredible businesses. And then for our investors, we typically sell them in a 3 to 4 year cycle. So what we in the real estate world, that's called merchant developing. So we develop and we ultimately sell. Very highly reproducible model. And the reason we also do shopping centers, and I'll get into this when we're talking about other real estate, is that they're triple net assets. I'll kind of stop there if anybody has any questions. Um, when it comes to commercial real estate, we kind of think of basically everything that we can see. You're driving down the road, you see multifamily, office, industrial, but there are some very distinct differences. And goes back to the inputs and outputs. Multifamily obviously is high density residential, but it's an operational business as well. So it's very important that a great location, multifamily, will function very well predicated on great operators. And operations and managers for that multifamily is very important. But it's not a triple net asset, meaning the rent, much like a rental home, includes insurance and property tax. So if those were to go up at a higher rate than your rental contract, then that's going to diminish your net operating income and ultimately your profit. Office, I think there's a structural change occurring in office throughout the country, largely resulting from how people work. I think there's a lot of people going back to on-site work, but I think office is making a rebound, but it's slow. But I think at the core, office will ultimately do well. It just has to be priced right. For individual investors, that's probably not one that it's easy to tackle. It's one that I'm sure that you can find investment vehicles to invest in office. Industrial is another one where I think as a retail investor, it's a little tough to get into because it's really large dollars, and who you're dealing with are typically very large companies. But it's a great space. It's abundant in Texas. We do a lot of industrial. Wherever there's large logistics centers, you're going to have a lot of industrial, where it be manufacturing or and particularly in Texas, there's a lot of manufacturing, logistics, reshoring and onshoring of manufacturing in the Texas market. Retail is what we do, but we do particularly convenience retail. Like I said, is within the demand drivers for the shopping centers that we develop is traffic as well as the homes that are around. Sometimes they're adjacent to grocery stores, but we are very distinctly different than your kind of classic malls, as well as what we call junior box, which is like where your Best Buy or Party City. They're just different. Medical, of course, is familiar with a lot of us. You can be an operator in the healthcare space, be a physician or an ASC owned by surgeons, or professional office buildings that may be owned by the provider, clinician, tenants of the building. And then lastly, storage. While it may be not a strictly a similar analogy, storage to a certain degree is very similar mathematically to multifamily, in a sense that multifamily is rented space. It's all the way down to units, but it's really about square footage. And it's a gross rent, means it's triple net. And storage is very similar, just smaller spaces, shorter contracts, and it's also technically triple net. So mathematically, multifamily and storage are very, very similar. And secondly, storage is also as good as the operators who are on that space as well. There's a fair amount of consolidation in self-storage, particularly the structured climate control storage. There's a lot of publicly traded companies in that space.
Can I ask a question about self-storage?
Yeah.
In South Carolina, I think we just buy way too much stuff, and there are storage centers everywhere. And, any patch of dirt, somebody's going to throw in a couple of units.
Mhm.
We've also got a lot of, kind of shuttered malls and, strip malls, full scale malls. Is there any move to taking over kind of like those abandoned spaces that are already there? So you don't have to have the new construction costs, but just kind of retrofitting the abandoned strip malls and creating the air conditioned self-storage
Yeah, I mean,
facilities.
it's a interesting segue to what you're talking about, which
Okay.
is, um, it's what we call dynamic repurposing.
Okay.
That you have real estate that already exists. Um, the original usage for that real estate has been extinguished, right? So it was a large scale mall. And the best way to think about malls, or I should say any large store, as it would be like a clothing store or what have you, and also even Walmart or your grocery stores. They're really just last mile warehouses.
Hmm.
That's what they are. It's the last mile warehouse for your clothing. So that's what your, Macy's is, literally. And they're very vulnerable to online shopping, right? Because if I can do delivery, um, and I'm not, per se perusing through clothes, like why would I go?
Right.
Then secondly, groceries also, while it's less vulnerable because it's last mile cold storage, right? But that's literally what grocery stores are. They're just last mile stores, last mile cold storage. So to your point, like dynamic repurposing, if something is, um, has kind of lost its functional life, how do I repurpose it? And that falls under this investing strategy of what's called opportunistic,
Okay.
right? So I'm going to buy a mall at an incredibly discounted rate because it has no net operating income. I'm basically buying it for land value. And because it's in a great location, I'm going to put in, structured storage in it. At the end of the day, though, you have to have very good confidence that the core business that you're developing, which is storage, is still going to be good.
Hmm.
So if there, I think storage is a good business, but you have to do a lot of DD, due diligence, to just make sure that there's going to be the volume and the traffic that's required because storage is one of those things that you're packing it and you're leaving, right? So whether it's around the corner or 10 miles away, it's not too impactful to the customer. So there's a lot of pricing competition, and I think that's why there's a lot of consolidation at the private equity and publicly traded markets level for storage.
Okay.
Great business, but like I said, you kind of have to do your homework.
Yeah.
That's with anything, right?
Yeah.
Um, investing options, this next slide, um, it, you can take every single one of any investment that's presented to you in real estate, and it will fall somewhere in this. And what I mean is core is just a function of risk and return. And that's with everything. If it is very low risk, let's just move away from real estate and just talk about the publicly traded markets. If you put money into a CD, your risk of losing your money is negligible, if not zero. But your return is only 2, 3% or whatever treasury is. So low risk, low return. And obviously, if you're putting money into startups, you're looking for the unicorn, you're going to have very high risk because your failure rate may be very high. Unicorns is 1 in 100 or 1 in 1,000 company is going to be successful, but it may be 100 times or 150 times. So when you get over here, where you're higher risk and higher return, it's very operator dependent. Like you have to just ensure who you're investing with. That's where the homework really starts. It can start over here, but this is where the homework on who you're investing in really, really matters. If you're buying a CD, there's not very much homework. If you're buying an S&P 500 index fund, I would say it's moderate risk, but it's moderate return. And so that's kind of how you have to look at real estate. Core is a brand new, whatever it may be. Um, uh, let's take shopping centers that we develop. We build them, we fill them up with great tenants that have 10-year plus leases, and then we sell them into the investment sales market. There's a lot of funds, private equity, high net worth individuals. They want low risk. They understand that their return is basically an arbitrage between cash flow and their, mortgage or their debt that they're getting from the bank. That's okay with them. Like that's what they're looking for. And that's what we develop. So we build core assets, but development starts with land. And so it's a little bit higher risk, but the return is much greater, right? So we buy land and we make a core asset. That's where the secret sauce comes in, right? Which is we're taking something and then developing a shopping center and we're creating hundreds of thousands of dollars in net operating income. And so whenever you look at investing, and it's interesting, I always joke when I'm talking to investors or leads or people who are interested in investing with us, we make as developers money for our investors the very first and kind of second day. And what I mean by that is that we have to buy the land right and we have to do construction right. Um, and that really goes with any type of real estate that you invest in. Um, you have to buy right. You have to transact correctly. And so it takes a lot of time on the front end. So I know that the buzz in the last 36 months, because a lot of people invested in multifamily. But if you look at the root cause of why some things were very challenging in multifamily, It's because they were bought incorrectly. The market always goes up and down. Real estate is a function, it's sinusoidal. I mean, the stock market's the same way. Everything, everything that goes up will come down at a certain point in time and it all oscillate. And so the only thing you can control day one in real estate is what you buy something at. And so we spend a lot of time making sure that we're buying the correct site at the correct price. Because once that's transacted, I can't change the location of what I bought, and I certainly can't change the price of what I bought it at. Um, Value add is something that may already exist, whether it be an old shopping center or what have you, and maybe it's partially filled up, and you have to do some capex to redo the parking lot or the roof, and there's some tenants that need to be turned over, maybe some better tenancy or lifting up the leasing rates because they're now coming up for renewal. Core Plus is more like a Class B, B plus asset that it's almost there. It just needs a little bit of tidying and work, and but there's no default risk or anything like that. And opportunistic, as you brought up, is something that just has to be completely turned over. It's something just a dynamic repurposing. One of those things we've seen is like offices that are being turned over to residential. It's just a complete seismic shift from what it was to something else. Any questions about that, Patrick?
No, this is all very helpful to see, and yeah, just learning about the different options that are out there and the risk and return associated with each of them.
Yeah, I think
Good
it's
stuff.
important that when people look at an investment opportunity, they categorize it mentally
Mhm.
into one of these. They should know they should be very comfortable categorizing it and understanding the risk reward that's associated with what they're investing in.
And
Yeah.
I guess what we would all like to see are low risk, high return.
And that's why we do what we do. But that always starts with a very seasoned operator.
Hmm.
Uh, you this is and we talked about this when prior to us starting the webinar is you kind of have to be in it to win it.
Hmm.
Real estate, particularly if you're in a running a syndicate like what we do, um, and we're taking investor dollars. This is all I do. I only do real estate because there's just, if you don't have your finger on the pulse of real estate and particularly the asset class you're developing, you'll miss subtle things that are occurring in the market, whether it be changes in demand driver or these type of things that can really affect your asset class. I was just sitting down with a capital markets person yesterday, and this is the very first time in 4 years of Malabar Hill that I've seen that the lending rate for our construction is pragmatically the same as our loan rates for permanent loans. And it's just an interesting period of time. And in all of those things are very telling of what's occurring in the market. It actually bodes well for development, but it's very challenging to just go out and buy an existing asset and try to create yield to create net operating income. And so it's important that not only do we focus on the asset class that we're developing, but we're able to also share that information to our investors. And we're one of those that, we won't do projects because we need to do projects. There may be times where we're acquiring quite a bit. There may be times where we're doing a construction quite a bit. And there may be lull periods because we don't think it's the right time to acquire or do construction. So that's being able to focus on one specific asset, kind of stay in your lane and really understand what's happening, not only in the financial markets, the macros, and I think that in real estate, it's one of those things, much like medicine, it's very hard to be a jack of all trades. And I know that's kind of funny coming from emergency medicine physicians, but I don't think real estate's one of those places. You can't do multifamily and storage and retail and industrial in as one business unit. They're very, very different.
I guess you could do them, but you would not be doing them well.
I say that, but the best way I think about it is, don't take my word for it. Go to some very large companies like the Brookfields of the world, um, the CBREs, the JLLs that are some of the largest brokerages in the world. Um, their teams are very, very linear or, very strict in what asset classes, because there's so much content knowledge, relationships, understanding of certain asset classes. So if the big boys are doing them all separately, and the publicly traded private equities of the world that are dealing in trillions of dollars of real estate, they don't just clump it all together in one business unit. I mean, they're very, very different. The the entire vertical of retail is very different than apartments, or industrial or office. And I know the investor mentality is, especially if you're busy in your um, medical practice or whatever your core business is, and you're like, I want to diversify over the real estate. At least take a little bit of opportunity and understand at least two or three of these asset classes you want to deploy capital into. And you kind of have to, there's no one-stop shop for real estate.
Mhm.
You may have to deploy with two or three different operators to kind of diversify your risk, and diversify your portfolio in real estate. I would be cautious to say, okay, this is one-stop shop. This fund does everything, because it just
Mm.
doesn't pragmatically work like that. Now, it doesn't mean you have to be in every asset class, but I'm just saying that if you deploy capital, deploy with an operator that really focuses, because real estate's such, as I said, it's going to go up and it's going to go down. And you won't recognize it if you're just not focusing on one specific asset class, and including geography. I mean, I don't play to understand every nuance of apartment complexes or storage. It's not my specialty. I don't know every nuance as it relates to single triple net assets like fast food pad sites. We sell them, but I don't develop them,
Mm.
right? We develop pad sites. We sell to Whataburger and other, fast food concepts, but I don't play to understand multifamily. Someone came to me with a multifamily project. I certainly think that I have the ability to go and learn about it, but it's not my core business, right? Um, I bring up this not to be um, these core financial terms, but oftentimes when I'm talking to investors, they're asking great questions. But I think it's very important that when we think about net operating income or cap rate or exit value is an output. The input is net operating income. Now, but net operating income is not one of those things where we're thinking about everyone pays their leases additive together. Okay, that's my net operating income. I think it's very important to understand from the very first slide that if I have a Domino's pizza in my shopping center, there was probably 50 variables in that lease agreement that resulted in that um, $35 per square foot lease. And ultimately, all the leases may or may not be very close to each other in that shopping center. And in an aggregate, that's the net operating income. When I end up selling the shopping center, the cap rate is in part driven by the market, and the capitalization rate is and it's very different for every asset class. So multifamily, one specific apartment complex may be 4.5, another one may be 6.5. Shopping centers, there may be some variability as well. And that also goes to credit quality if it's a Starbucks versus a local chain coffee place. And
Mhm.
so while I don't expect our investors to understand every nuance of it, I think they should understand that these, simple numbers are based on very, very complex positioning as it relates to leases and development. And if they understand the gravity of that, they want to ensure that the operator who's building these shopping centers or building apartment complexes, they also know it as well. That's why I said you kind of have to be in it to win it, because all of us can look at an Excel, understand the formulas, but every input may have 50 variables sitting behind it. Any questions about that, Patrick?
So that's what you and your team are dealing with. You're dealing with all of those 50 variables that goes into each cell with the hopes of being able to simplify it, be able to explain it to investors so
Yeah.
that they feel more comfortable with their decision to invest their money into the work that you are doing. So you do that work on their behalf and
Of
then
course. Yeah.
have to
And
explain it to them.
yeah, I mean, it's as simple as, you know, I talk about shopping centers because all of us go to shopping centers, right?
Mhm.
Whether it be at the entrance or your community or what have you. Set aside all these numbers, right? Variables are not always numbers. They end up being quantifiable to a number, but they don't start as a number. Let me
Mhm.
explain. If my shopping center is not easily visible from the intersection, it's going to impact the lease that I'm going to get from that tenant.
Mhm.
So visibility, while it's not a number, it creates an impact on the number. If it's if I have to go down the street, make a U-turn because there's not an easy accessible point into my shopping center for those tenants, it's going to negatively impact how much I can get from a tenant for lease.
Mhm.
Again, it's not a number, but it translates to numbers. So it's a
Right.
variables that are in aggregate that impact that net operating income. Now that's just shopping centers, and that just gave you two. They're intuitive, right? Like I don't want to make a UE to get back to that shopping center. So guess what? The traffic into that shopping center is going to be less.
Yeah.
That's no different than apartment complexes, right? If the apartment complex is not in the path or a main artery into a work node, it means that I can't get easily accessible to a highway, or there's no grocery store around for 5 or 6 miles, or it's a poor school district. All of these are going to negatively impact that net operating income. And it will ultimately impact the cap rate. So both of those are being impacted, which guess what? Impacts your exit value. So for us, our investors, they expect us to understand these things. And that's why we spend an inordinate amount of time on location, as we talked about, or due diligence as it relates to accessibility, all of these type of things into the site, visibility into a site. I've dropped sites because I couldn't get a median break. So, the median is the partition between lanes in ongoing and outgoing traffic. And if people can't get in, then what am I looking at? Traffic only from one direction? It's like impossible, right? So you're absolutely right. Again, I don't expect retail investors to become experts on that side of it. What I'm basically asking people to understand is that it's a lot more than net operating income and cap rate, exit value. But we mitigate all of those things. That's why we do what we do. Um, the next couple of slides really just break down what NOI and how it's impacted. I mean, net operating income, I think this is important because, as I said apartment complexes, as well as in storage, those are what we call gross leases. So whatever you charge as a rent, it includes property tax, insurance, etc. And so if those rise at a higher rate, then the rent that you can charge to the ultimately to the customer, it's going to impact your net operating income. The real reason we like shopping centers is because it's triple net, meaning there's an extra charge above and beyond that for operating expenses. And so if property tax or insurance were to go up, then it doesn't impact our net operating income. And this is ultimately why institutional capital, meaning private equities, high net worth individuals, family offices like triple net assets because it's clean. While we're good stewards of our properties, we're going to fight property tax and we're going to try to shop for the best insurance value for our tenants. It still doesn't impact our bottom dollar. So this is very important that if you're investing, you understand the difference, and it's very clear what is a triple net asset and what is not triple net. This was also, particularly in the Sun Belt for multifamily, was very challenging because we had a series of natural weather events that really escalated insurance cost for multifamily quite a bit, actually. Cap rate, this is an output. And so it can be impacted by the quality of your tenants. So there is wiggle room in this, but this is largely market driven. So again, it's an output. And then exit value is the ultimate output, which is an aggregate of cap rate as well as NOI. And so if you put these all holistically together, you're going to start to get a better understanding of whatever asset class that you are investing in. But one of those rules of thumbs is that cap rate swings is very important. Multifamily, a lot of them were bought at what we call compressed cap rates because the cost of debt was very low, at least for a period of time, pre-2022. And so there was a lot of multifamily that was purchased at very low cap rates, which ultimately meant they had very large purchase values. Once interest rates rose, I think 350 to 400 basis points, so 3.5 to 4%, that expanded this cap rate. And when you expand a cap rate by 2-3%, you will evaporate most of the equity that's in the project. And while it's very simplistic to say that, it is something that can happen in real estate. And so it's very important for us to look at all of these numbers very holistically. And it's a large reason why we don't acquire. We always are developing. So we build at cost and we sell at a premium versus buying at a premium and then letting rent growth create increased exit value on an existing asset. So it's just a little bit different investment philosophy. But development is not within the capacity of all operators. Development is just a completely different, skill set as it would be.
Mm-hmm.
Yeah. And so kind of just to kind of wrap up, I know we didn't talk a lot about visual pictures of real estate and so forth, but I think it's just important that this idea of valuation being very linear in real estate, it's easy for people to digest to say, if I have this and I do this, it will just linearly go up. But what I've warned, particularly physicians, because we're high earning individuals, is that just because you have money and just because you're deploying money doesn't mean you will make money. I think that's a very, very important lesson for a lot of people, including myself. Early in my career, I deployed a lot of money, not necessarily in real estate, but in a lot of investment investments, whether it be investment vehicles, and they did not result in what I expected. I lost money. And it's because I was trying to be very black and white. If I did X, and I put X amount of money in, I should definitely get Y. And that's how it was explained to me. Um, and it didn't turn out that way. And so real estate, if like I said, if people watch this and they walk away with a lot of questions, I want them to. A part of my role at Malabar Hill, obviously outside of running finance, is just educating. If it's not the first, thing that I talk to people about, the first time they come to us and it's 3 or 4 or 5 projects later that they decide to invest, to me, that's because they've taken an opportunity to really understand what they're investing in. And because if they understand it, they'll, kind of full-heartedly go in and dig deep and really ask some really good, hard questions. It makes us better in being able to engage people in what they're looking for. Development is a game of patience. But if they understand what they're investing in, regardless of not only our stuff, but if they take away some of these core things that we talk about, and it makes them better at investing in multifamily or storage or what have you, fantastic. I'm the first to say that I invest outside of my own company, Malabar Hill, in real estate. So it's not that my only real estate holdings are Malabar Hill. I'm diversified in apartment funds, in grocery anchored shopping center funds, and opportunity zone funds. So I'm myself am diversified as well outside of my own core company because I don't want everything in only one asset class either. Um, and so again, like I said, real estate, and particularly the reality of real estate, is it's not you put in X money and it just goes up. It's multivariable. In fact, everything that we invest in, whether it be stocks, bonds, it's easily explained as a linear function and it'll go over up 6 or 8% per year, but that's not how any investment is. It's a series of inputs.
Yeah.
Yeah.
Well, I see the contact us right underneath that, but
Yeah, yeah. I'm sorry.
if you feel comfortable sharing some of the different projects that you're currently working on,
Yeah.
I'd love to be able to capture those for the recording.
Yeah, give me 1 second here. Let me
Sure.
stop sharing for just 1 second.
I have a question also,
Yes.
if you're available. Thank you so much for their presentation. Just a quick question. So, what are some challenges with ground up development versus already purchasing an existing asset? So, if you can weigh on the pros and cons, and why Malabar Hill Capital goes the ground up development route.
Yeah, it's a great question. Thanks for asking it. That I think the best way to describe development risk is there's 2 sides of development risk. Location, and I know it's very cliche, and I tell this to a lot of people, but you have to have a great location. You can have a poorly constructed whatever you build in a great location, and it'll probably do okay. What I mean by location, traffic, demand drivers, rooftops, etc. It's very impactful to any type of business. So that's the first and foremost. So development risk is not a function of, oh, there's cheap land here. This is where we should develop. We don't start off with looking at land price. What we look at as location. Always it starts with location. I'll pay more per square foot for a great location than next to nothing for a bad location. Because again, at the end of the day, I can't pick up and move the location. So that's first and foremost. The other part of it is, and it sounds simplistic, if I say I'm going to build a shopping center, can I build a shopping center? What do I mean by that? A municipality has zoning restrictions, permitting restrictions, etc. So we do not take on any zoning risk. We only go into areas where we already know we can build a shopping center. So there's not this idea that the municipality will come back and say, hey, you can't build a shopping center. Or the community, means the master plan community, goes, not in my backyard. I don't want a retail shopping center there. It's already zoned for commercial real estate. When you bought your home, you already know the commercial shopping center was going to go there.
Okay.
So those are things that are occurring or should be mitigated before we ever put a shovel into the ground. The second part of development risk is, if I build a shopping center, can I fill it up with great businesses and then ultimately sell? And a large part of that has to do with location, meaning if I have 5,000 homes around us, it's funny, over the last 3 or 4 years, I pretty much know the core business development things that need to be checked off for almost every business. A dentist needs 2,500 lives. A primary care office needs 3,000 lives. A Domino's Pizza needs demographics between 100 and 125,000 household income. Little Caesars won't go into any of our shopping centers because the demographic is too high. It has to be less than 90,000 household income. You see, so we do all of this as it relates to void analysis. Funny enough, AI has certainly been very disruptive and helpful in real estate. There's programs like Placer AI that we're doing our void analysis with. So we know the businesses that are going to want to be in that shopping center. That's where development risk, and we mitigate that with, as with anything, data, a lot of data. Yeah. So hopefully that answers your question.
Yeah.
The stuff and you can see, I didn't talk anything about finance because, if it works on the back of an envelope, it's going to work. Like, we're not very creative. I mean, Houston is, if there's 5 or 10,000 homes and there's no shopping center and you're first to market, you're going to be successful. It's a real hard question is, can you acquire that site? And the only way you can ensure that is being a high volume developer, because we're amenitizing a community. And the community developers like Hines, Starwood, Brookfield, some of these are publicly traded company or multi-billion-dollar companies. They're not going to risk an entrance of a master plan community to someone who hasn't developed before. Right. Because if you think about it like this, as a developer of a master plan community, their core business is selling home sites to national tract home builders like your D.R. Hortons of the world. D.R. Horton can't sell homes unless there's an amenitized community. If someone feels like they can't, DoorDash pizza because it's 30 minutes away, they're not going to buy a house there. I know it sounds very simplistic, but real estate's one of those things. It's core consumer marketing business. It's just what it is. And so it's easily understood. It's sometimes easily missed, by people. One of the shopping centers, to Patrick's point here, that let me share my screen. Yeah. Can you see my screen?
Yep.
Okay. Houston is basically a clock base. There's highways basically emanating from downtown in every direction, with the coast being to the south. And we're just a series of circumferential circles. Houston's pretty well designed as it relates to our highway system. The area that we're developing is a 5-acre parcel in northwest Houston. It's about 25 miles outside of downtown. Along with this, and I'm happy to share, is that this Magnolia community was the fastest growing community in 2025 in the United States. It sold more homes than any community in the United States. And I don't know. I'd like to tell you I know why people want to move to Magnolia. It's absolutely beautiful. It has topography, but it's actually blown up. I don't know how else to describe it. This is our second project in Magnolia. Our first shopping center is a little bit to the east, next to a large grocer named HEB. If you're not from Texas. And then there is a master plan community on both sides of the highway. That's how large the community is, over 3,000 plus homes. And we're on the main entrance on the west side of the highway of two communities, Audubon as well as Magnolia Ridge. We typically will not develop anything less than 20,000 square feet. If we go more than 20,000 square feet, it's typically in multi-phases. So we'll develop or build about 20 or 30,000 square feet. And then depending on leasing velocity, we'll build the last phase. In this particular project, we will sometimes buy extra land because it allows us to buy the entire parcel at a much lower amount, which is basically a wholesaling of land. And so that's where this pad sites come in, which is extra about 3.5 acres. We're not going to develop them. We're just simply going to sell them. All the profit is accretive to the investors. And then this main thoroughfare is about 30,000 vehicles per day, and it's already expanded to 4 lanes, 2 in either direction. And our target tenants, a lot of these are going to be very familiar. These tenants are largely in our other shopping centers. We have over 20 shopping centers in the Houston market in different phases of development. A good case study for this area is the shopping center that we're already building. This is about to break ground next month. It's 60% pre-leased, meaning, which is the next point, is we don't just build shopping centers and then wait for tenants to come. Once we have a site plan and we're in design phase, we start what's called pre-leasing. We'll start signing leases with future tenants. And so in this circumstance, 60% of this 34,000 square foot building is already pre-leased. So we raised capital for this project at the beginning of 2025. Fast forward about 15 months, we're 60% pre-leased. Arguably, this project may be fully leased by the time we even deliver the building, so it's moved pretty fast. But I think it just speaks to the amount of activity and retail activity in this area. Something interesting to note is we think of these shopping centers as small businesses. But one thing that has occurred since COVID, in large part because it's costly to develop, is that businesses that used to have their own freestanding building, like a swim school, so they would buy an acre, or a Montessori school would buy an acre and then just build their own building, are now finding themselves in shopping centers. And it's just faster for them to develop their cash flowing asset by just going into a shopping center. So this also bodes very well for this asset class. This slide just touches on land acquisition strategy, buying at wholesale, selling the extra parcels at market retail value, and how that increases value and economics for our investors. And I know we're kind of limited on time, so I'll just jump down to our investment itself. We're raising about $3.5 million for this project. Our target investment period is about 36 to 48 months on phase 1 to phase 2. We're merchant builders, so we do not hold a shopping center for 5, 6, 7 years. When a person invests with us, there should be no question about our exit strategy. We're looking to sell. Minimum investment is $50,000. We're management fee light. We don't tack on a lot of fees. Our intent for our investors is that 99% of their equity capital day one goes right into the project. because at the end of the day, buying a parcel of land is not ultimately the project. The project is to get it out of the ground. And so we really want to start construction as efficiently as possible with our investor equity and then share in the profits at the end. We keep a pretty straightforward waterfall. There's no catch-up model. There's no guarantee of promote or carried interest to the general partner. All capital has to be returned to the investors at the end of the project. All accrued preferred equity has to then be returned to the investors. And only thereafter, the remaining 15, 17% of profit is where the promote it comes from to the general partner.
Wow.
Our timelines are, like I said, 48 months. It's demonstrated here where we do a staggered phase one and a staggered phase two. Certainly, we could build it all at once if the leasing velocity demands it. We do a little bit of a land loan on this land because of the land parcels. It's just more efficient and cheaper cost of capital as it would be just to take on bank debt for land that you're ultimately going to sell. And this is an all-in project. So what I mean by that is interest reserves, operating reserves, all leasing commissions, hard costs, permitting fees are all contemplated in this budget. I bring that up because our intent when we do our projects is not to come back to investors for capital calls. We've never had a capital call, and a large part of that has to do with we're just conservative in our underwriting. If you're happy with what you see, and we're able to deliver on those numbers, that's success for us. We're not trying to shoot for the moon. What we build, you win by us doing, base hits and second base hits. You can't, hit for the fences every time. So we just want to be very consistent in our methodology of developing. This slide demonstrates our waterfall. As I mentioned, all capital as well as preferred equity has to be returned back to the investors first and only thereafter. And these numbers are net of promote and fees. And we're pretty straightforward. We're very tech-centric. We have an investor portal. I would say the majority sentiment from our 500 plus investors is we communicate probably too much. It would be very rare not to get an email every week, not necessarily about your project, but just in general about what we're doing every week. We do quarterly updates on project specific. You'll get that. Along with that update is a kind of a high level update across all of Malabar Hill's milestone projects. What we're really trying to do is educate on this asset class. So we're not going to educate on apartment complexes. It's not our core business. But if you walk away after even one investment, you should have a pretty good understanding about shopping center development. And outside of that, all documents reside on an investor portal. And I would say, pretty good about K1s. Everything, including your profit loss statement and balance sheet for the project, is transparent. It's uploaded into the investor portal. So you don't just get a K1, you'll get the project level balance sheet and profit loss statement. We do that because more functionality, a lot of investors, accountants need it to understand the K1, but it's a large in part because we want people to understand that we're being fully transparent about the projects. And we'd love to hear from people. If it's not about investing and you're just looking to just kind of get your feet wet into understanding real estate, I'm happy to always connect and expand my network.
Awesome. Well, this has been very informative. This is definitely out of my wheelhouse. And I know that, this is why we have these types of events, is to be able to expose us to what else is out there. And, it's really inspiring to see, a colleague who once worked the night shifts, the weekends, the holidays, now
A
expanding
lot.
their horizon. Yeah, lots of
Yeah.
them.
Yeah.
And doing something that brings you joy
Yeah.
and that inspires you. So really appreciate you sharing your journey, your insights, your expertise with us. Um, and look forward to more conversations. And just to reiterate, Shift Change is there for you to utilize. Feel free to come in at any time. But yeah, look forward to future conversations, and hopefully we can set up a call. As you're talking, I'm thinking of all these connections that I'd love to share with you.
Yeah.
I saw some of the urgent care names that showed up on your on one of the slides, so would love to help you in any way that I possibly can.
Really appreciate it, Patrick. Thank you.
Absolutely. Anybody else, Doug or Ezanika? Any questions, comments?
No, no questions. This was very, very helpful. Thank you so much.
Awesome. Well, thanks everyone.